We wanted to highlight an opportunity that has resulted from the recent rise in bond yields. In particular, there's an opportunity to take advantage of the rise in yields in short-term bonds, and the rise has been the result of a rejigging of expectations about how high the Bank of Canada will raise its overnight rate as it seeks to bring inflationary pressures back under control. Now, the rise in yields has been so dramatic that we've seen the worst bear market in bonds that we can recall, and that's going back to the 1950s. It's good to know, though, that the bulk of any increase in interest rate happens. In fact, about 3/4 of the rise in long-term bond yields happens before the central bank does its first hike. And that makes sense given the bond market anticipates the need the central bank to raise its rate, moving well ahead of that first rate increase. And we know that the bank did its first hike in March. So we should be in at least the seventh inning of this bond bear market, if not the last inning already. And why do we say that? Well, the futures market has already priced in or anticipates that the Bank of Canada will hike its rate from the current 1% to just shy of 3% by year end and 3.25% at the peak. Importantly, it also expects that the bank will cut rates after 2 years, taking the bank's overnight rate back to 3%. Short-term bond yields have risen dramatically to reflect these expectations. For example, since year end, the 5-year Government of Canada bond yield has risen from about 1.25% to just under 3% now at 2.85. So yeah, those yields could rise a bit more if the bank were to hike its rate to the 3% area. There's also a good chance that the bank won't be hiking its rate as much as the market currently expects. And that's because the economy could slow faster than they expect or inflation could also recede quicker. In fact, the bond market's already sending a warning that the economy could slow sharply in the next year. And that message is seen really in the shape of the yield curve. About a month ago, we had a situation where 2-year yields in the US were higher than the 10-year yields. In the past, that's been a great indicator that a recession was likely in the next year or so. And that seems a bit crazy today, given how well the economy has been doing in the last year. But the bond market really has the best track record at forecasting recessions. However, that track record is best when it's the 3-month T-bill yield that moves above the 10-year yield. And that's happened about 8 times since the 1960s. And every single time the economy has moved into recession in about 10 months. This latest episode, though, wasn't the T-bill yield, it was the 2-year yield that went above the 10-year yield. But that has also preceded the T-bill yield moving above the 10-year yield, so it bears watching. And if the central bank keep raising their rates as quickly as currently expected, then the risks are going to increase for a recession next year. We've already seen nascent signs that the higher yields we're seeing this year are having an impact that's slowing the housing market. After all, debt levels are high, meaning interest rate increases bite quicker and harder than they used to. So if the economy does continue to slow, that should put the brakes on further rate hikes, meaning the current expectations for how high the bank will raise its rate may be excessive. In fact, we expect that the bank will be done its rate hike campaign once it reaches the low to mid 2% zone. And an earlier stop than what's currently expected may result from the usual pattern where the central bank hikes rates until something breaks. Now that something may be a major decline in the stock market or the economy, or something else we don't see yet. And to be fair, the central banks don't know where the pain point is on the economy or markets, but they do know they have to regain their inflation-fighting credibility. And that credibility was severely damaged in the past year as they left rates too low for too long and further stimulated by buying bonds. And we know that not only are they hiking interest rates this year, we know they're going to start reducing their balance sheets. That means not only are they no longer increasing their balance sheet by buying bonds, they're no longer going to reinvest proceeds from coupons and maturing bonds that they own. And no one has a good handle on how this may impact markets and interest rates this year. So that's another potentially serious risk. It could cause a problem for the economy or markets. Regardless, even if short-term rates were to rise another 0.5% from today's levels, the opportunity we see in short-term bonds would still outperform cash. So what we're recommending isn't a move into regular fixed income funds. We're recommending that investors look to move out of cash reserves they've been holding and move into short-term bond funds. We'll note that many of these types of funds were yielding in the area of about 1.75% at year end and now yield above 3%. We'd also note that moving beyond a short-term fund to more traditional longer-term bond funds doesn't really provide much of an increase in yield, given the yield curve is so flat. So from a risk-reward standpoint, it looks to us like it's better to just move from cash to a short-term bond fund. Getting a good increase in yield from likely around 1% today in cash or money market instruments, over 3% in a short-term bond fund. And even if those short-term yields rise another 0.5% in the next year, a short-term bond fund should still provide a total return that beats cash. So take advantage of the sale on short-term bonds. That sale means yields are attractive again.